Good morning. Grab your coffee, pull up a chair, and let's have a real conversation about that retirement statement you probably haven't looked at in a month. You see the numbers, you see the ticker symbols, and you feel a sense of security? You think you're invested in solid world-leading companies with unshakable foundations. But here's the deal. Most of what you own is actually invisible, and right now, it's starting to evaporate. Let's break down a number that blew me away when I first saw it. 92%. That's the share of the S&P 500's total value that's currently tied up in intangible assets. We're talking about things you can't touch: software, brands, patents, and proprietary data. In 1975, that number was just 17%. Today, it's the whole game. We've built a global wealth machine worth nearly $80 trillion on the back of ideas and code. It's what economists call the intangible asset market value, and it's been the greatest wealth creator in human history. But here's where it gets interesting and a little bit scary. For decades, those intangibles were considered moats. If you owned a piece of software that took 10 years to write, you had a castle. No one could touch you. But we just entered the age of AI parity. What happens to the value of a moat when a machine can replicate 10 years of human coding in 10 minutes for the cost of a monthly subscription? The math is starting to change. Let that sink in for a moment. If 92% of our wealth is built on the assumption that ideas are rare and code is hard to replicate, what happens when those things become commodities? We're not talking about a market dip. We're talking about a fundamental repricing of reality. And if you're holding a 401 key, you're on the front lines of this shift. Okay, let's talk about the real problem. There's a term I want you to remember: proprietary code depreciation. In the old world, meaning like 3 years ago, a company's software was like a piece of real estate. You built it once, and it yielded rent for years. But today, thanks to models like Claude and O1, that code is depreciating at an estimated rate of 45% every single year. It's not a castle anymore. It's an ice sculpture in the middle of July. Think about the SaaS market, software as a service. This was the darling of every retirement fund. At the peak in 2021, these companies were trading at 41 times their revenue. 41 times? Today, that multiple has cratered to about 7.5. That isn't just a correction, it's a realization that the moats are being breached by digital salt. AI is dissolving the value of software because AI makes software cheap to create, cheap to replace, and nearly impossible to defend.
I know, sounds dramatic. But look at the data. When the cost of production for an intangible asset drops towards zero, the market value of that asset eventually has to follow. It's basic economics. We're seeing a massive transfer of power from the people who own old code to the people who use new AI. And if your pension fund is still betting on those old intangible premiums, they're essentially holding a bag of melting ice.
And here is the part nobody's talking about. This isn't just a tech problem. This is a collateral problem. Those invisible assets are often what's used to back up massive corporate loans. When the value of the software drops, the collateral vanishes. It's a $2 trillion shadow debt trap that most investors don't even know they're caught in. So the question is, who is holding the trap and who is the bait? Now, this is the part I find wild. So here's where the story takes a turn. While the public is busy looking at their shrinking SaaS stocks, the smart money is doing something very different. They're fleeing paper wealth and racing toward what I call proof of physical. Look at the private credit market. It's exploded to $2.1 trillion. Why? Because banks are too scared to lend to companies whose only assets are ideas. So these companies are turning to shadow lenders. But here's the kicker. 15% of these borrowers are now using something called PA, interest, payment in kind. That's a fancy way of saying they can't pay their interest in cash, so they're paying it with more debt. They're giving the lender more IOUs because their software isn't generating enough cash to cover the bills. It's a debt spiral wrapped in a software pack. When 40% of private borrowers are facing negative free cash flow, the system is screaming for a change. And you can see where the capital is going if you follow the energy. Look at nuclear power, specifically small modular reactors or SMRs. Amazon just led a $500 million funding round for X Energy. Why? Because AI might make software cheap, but AI makes electricity incredibly expensive. You can't hallucinate a gigawatt of power. You can't prompt a copper mine into existence. The world is realizing that in a world of infinite digital content, the only things that truly matter are the things that are finite. Copper, uranium, land power. These are the new moats. While your 401 key might be heavy on companies that disrupt with apps, the world's largest distressed debt funds, the guys like Apollo and Oaktree, are sitting on $400 billion in dry powder, waiting to buy up the senior liens on physical infrastructure when the intangible bubble finally pops. If the world's most sophisticated investors are moving from ideas to atoms, what does that tell you? Let's zoom out for a second. Is this a new crisis, or is history simply repeating itself in a language we don't yet speak? If you look back at the railway mania of 1847, you'll see an 86% similarity to what's happening today. Back then, everyone thought railroads were the infinite growth engine. People poured their life savings into intangible promises of future transport. When the math stopped working, the bubble burst and the government had to step in to consolidate the mess into state-backed utilities. But here's the problem. In 1847, you could see the tracks. In 1998, with LTCM, the Fed could get 14 banks in a room and fix it. Today, the risk is hidden in thousands of opaque, illiquid private contracts and software valuations that exist only on paper. There is no room to get everyone into. The bank exposure to these non-bank financial institutions is over $4.5 trillion. That's more than the core capital of many major banks. This is a moth problem that even the Fed can't easily print away. You can print money, but you can't print value back into a brand that AI just made irrelevant. You can't print uniqueness back into a line of code that anyone can generate for 5 cents. We are witnessing a systemic liquidation of paper wealth. It's a return to the mean, and the mean is physical reality. It's not the end of the world, but it is the end of the hallucination that we could grow forever on invisible assets. So if the system can't be bailed out in the traditional sense, what does this mean for the person just trying to retire in 10 years? It means the old 60-40 portfolio, 60% stocks, 40% bonds, might be built on a foundation that's currently melting. We have to start looking for proof of physical. We have to start asking, if the internet went down tomorrow, what does this company actually own? Let's connect the dots. Your retirement isn't doomed, but it does need a roadmap for the age of physical proof. The IMF is already reporting that 40% of private borrowers are in distress. We're seeing secondary markets for private credit trading at 15% discounts. These are the early warning shots. The intangible hallucination is coming to an end, and the physical reality is reclaiming its throne. What does survival look like? It looks like prioritizing assets that AI can't replicate, energy, raw materials, and the physical infrastructure that powers the digital world. Think about it next time you see your grocery bill or your power bill. Those aren't just costs, they are the indicators of where the real value is moving. The era of the intangible hallucination is ending. The age of physical proof has just begun. We're moving from a world where we traded paper promises to a world where we trade physical certainties. It's a fascinating shift. And honestly, this is the most interesting time to be an investor in the last 100 years. Just make sure you're not the last one holding a moat made of melting ice. See you tomorrow morning?